It was another sell-off day on Wall Street with the S&P 500 down well over 1%. And we did only have two sectors that were up today. Once again, it was energy and utilities. We also saw that Twitter was in play today with Elon Musk making a bit of a surprise hostile takeover offer. And then we also had a rare Thursday options expiration since tomorrow the markets are closed. We'll talk about all of that. Then we'll get into our trade application example where I wanted to show you a very similar trade to what I did back on March 1st, but show you some of the key differences in how the options pricing model differs when volatility is at different levels. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 14th, 2022. First off, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into our description area and make sure you're signed up for our email distribution list. In addition to that, we're heavy users of Twitter, perhaps Elon Musk's Twitter after today's news. Nonetheless, we use it quite a bit, and we're very thankful for those of you that follow us. In fact, I happened to notice today, I got about 50 new followers within about a 2-hour span. Not exactly sure why that was. I tried to look at the folks that started following me, and it seemed like all of them were trader or financially oriented, but most of them from the country of India. So I'm not sure what list I popped up on, but if you are one of my newer followers on Twitter, I appreciate having you here, and hopefully I can provide some value for you moving forward. Again, my handle is at Brandon Van Zee, and we really appreciate those of you that click like and retweet on these Market Outlook related tweets as well. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And as you can see, I've got our heat map pulled up here for the S&P 500. And once again, sad to say, we were down and down more than 1% across the S&P 500. As you can see, not a whole lot of consistent green patches out there here today. In fact, there were only two sectors that did manage to close in the green today, one of them being energy and one of them being utilities. Stop me if you've heard that before. Of course, just joking there, but you guys saw on Tuesday when I did the video how energy had been number one on the sector selector for the better part of the last 3 or 4 months, and utilities have been right there at the number 2 spot for the last few weeks as well. And so not a huge surprise that the only two sectors that were up today are the two that have been strong and leading us this entire way. All of the rest of the sectors did close in the red, but naturally we do have some areas that perked up because of earnings announcements. So as an example, I do see Citigroup and US Bank showing up here in the middle in the green. They both reported earnings here today. However, Goldman Sachs did end up just a touch in the red. They also reported earnings from the financial sector there today. Other areas that perked up just a little bit. AbbVie perked up, but it's had a tough week after hearing that one of their executives is leaving and going to Walmart, and that kind of shook things up there with that stock a little bit earlier this week, but good to see a little bit of stabilization here as we end things out in this holiday shortened week. Remember, especially for those of you that are newer to the markets, tomorrow is Good Friday, and that is a market holiday, so today was options expiration day, a rare Thursday options expiration day, since the markets will not be open tomorrow, and we'll have a 3-day weekend. Other stocks that closed in the green, I see Caterpillar and John Deere both doing pretty well down there from the construction and machinery area. I see Nike coming through with a nice green spot there as well, up about 4.5%. Interestingly enough, Twitter actually closed a little bit lower in the normal session here today. But after hours, as they've been talking a bit more about this whole Elon Musk news, it looks like it's been perking up just a little bit after hours as I've been kind of following it on my platform and also on CNBC. So that one started off the day with a bang because Twitter was trading higher in the pre-market session once news hit that Elon Musk had made an offer to buy the company for about $54 or thereabouts, somewhere in that general vicinity. As the day kind of went on, a lot of people became skeptical as to whether he would be able to actually finance that, even though he is the world's wealthiest individual. But it's still tough to pull off multiple $billion worth of an acquisition like that. Plus, just some of the way that he phrased things suggested that maybe he wasn't quite as serious as what you would normally find with a takeover offer, especially in a case like this where it would be a hostile takeover offer. But you can see down here, Twitter did close the normal session down about 1.68%. So that was a bit of a surprise because I think a lot of people felt like Twitter was really going to be rallying furiously today. In terms of the red patches now, you don't have to look very far. They're all over the place. And in particular, I would point out that it's the big boxes or the big rectangles that really stand out and are the most concerning. Remember, the S&P 500 is a market cap driven index, and what that means is that the bigger you are as a stock, the more influential you are on the end result of the S&P 500. So we had plenty of days over the years where most stocks in the market were actually down, but the S&P 500 closed higher because the FANG stocks were all up. Well, we're not really getting the help from the FANG stocks, it seems like these days. You can see once again, Microsoft, Apple, Alphabet, Amazon, Tesla, Nvidia, Broadcom, all those big players, even Meta/Facebook, all of them struggling here today and really selling off into the close. So it kind of left a bad taste in the mouth as we headed into this holiday weekend. Perhaps folks didn't like to hold their stock portfolios into an extra day into the weekend where anything could happen with Russia, Ukraine, or inflation stories, or who knows what might pop up there. But it just wasn't a really great feel when the stock market effectively closed at its lows here today, and the selling was pretty broad-based. Let's go ahead and move on to another part of the platform here and show you from a market breadth perspective how things shook out here today. And you can see that from the S&P 500's perspective, only 167 stocks closed in the green today, whereas 330 closed in the red. So that is a 2-for-1 day that we have there. There were 2 sellers or 2 losing stocks for every winning stock here today. So again, it wasn't just the big companies, although they certainly played their role, but this was a broad-based sell-off here today, even across smaller companies as well. Let's go ahead and now take a look at our chart 6D. I like to pull this up whenever we have a move of at least 1% up or down. Today, sadly, another one of those down 1% days. And as you can see, that allowed this red bar to cross down and below this blue horizontal line. And again, stressing how more volatile things have been here recently compared to where things were back here during the summer of last year when things were relatively calm and we had relatively few amounts of 1% up or down days. In the last 2 or 3 months, it seems like 1% up or down days seems to be the norm. In other words, it's almost rare when we don't get one. With yesterday being a 1% up day and then followed immediately with a 1% down day, you can see that we effectively did engulf yesterday's candle there as well. So not a great look for people who are hoping that yesterday might have led to some sort of a bounce here and then one day later completely eliminate all of the gains that were had just yesterday. You'll notice down below that the VIX did tick a little bit higher, not dramatically, but the VIX did hang out here at around 22 at the end today. Real quick, since we're talking about the VIX, I'm going to try to stress a point to you guys later on in the trade application example of the video and prove an educational concept to you. And so while we're looking at it here, I just want you to pay attention that right here on March 1st, the VIX was trading at about 33 on that day. So just keep that number in mind for later on in the video. The VIX was at 33 on March 1st. Today it's at 22, so dramatically down. So kind of interesting there, because if you were to look at where the markets were on March 1st, it would have been about right here, just a touch lower than where we're trading. So there's a pretty big difference in volatility, even though the prices are nearly identical from where we're at today versus where we were back here on March 1st. Anyway, again, I'll get into that a little bit more later. Call that a tease in the business. So let's mosey along with the other charts before we get to it. And let's take a look at our normal market forecast 4 grid. And this is chart 4B for those of you that are premium members following along at home. Remember, those of you that become premium members of Market Scholars not only get access to the 10 classes that David and I teach you throughout the week, where we implement various trading plans and strategies to help you with everything from short-term swing trading to long-term dividend growth investing and portfolio management with ETFs. But not only do you get access to all that content that David and I are giving you through the week, but we also give you access to all of our 50+ charting scripts for those of you who use the Thinkorswim platform to import into your own Thinkorswim platform. And so this particular chart 4B will help us look at all 4 of the major U.S. equity indices side by side, and there's a color coding system that assists us with helping us understand, whether the postures are bullish or bearish and who some of our leaders and laggards are without having to investigate it too thoroughly because of the color coding situation. So let's get into it. You can see here the S&P 500 was down 1.21% here today. So a pretty ugly day. Again, we've had a lot of 1% down days, so it's not anything out of the blue, but just a reminder that things have been a little bit more volatile. And it's an important day from the aspect that yesterday the S&P 500 managed to close above its rising moving average. Notice that moving average color changed to green, and this is a 30-day moving average that we're using here. So one day later, now that we close back below the 30-day moving average, notice the moving average color went back to yellow. And in this case, what that constitutes is prices below a rising moving average. Now, if there's enough wear and tear on the chart, eventually the moving average will start rolling over. And when it does, if price is still below it, that moving average will change to the red color, like we saw back during this particularly difficult era for stock traders. And so, I'm just bringing that up because we've actually had, in the last 5 trading sessions, we've only had 1 up day. So 4 out of the last 5 trading sessions have been down. And that is going to work its way into the 30-day moving average. Remember, it's a lagging indicator, and all it's doing is looking at the closing prices of the last 30 days and then plotting the average of that. So if we get a few more down days in the next week or so, I have a suspicion that this S&P 500 moving average is going to roll over and therefore change to that red color, assuming price is still below it. So be on the lookout for that possibility. In terms of the market forecast posture, remember we use this green line on the market forecast to help us establish that. That's the intermediate line. And as it stands right now, you can see the intermediate line is at 56 and falling. So that's why we have that light pink background color there, telling us that we do have a weekly bearish posture on the S&P 500 right now, according to the market forecast. Remember, if that green line were to clip down below the 50th percentile, this background color will change to dark pink, like you see down below here with the Russell 2000 as an example. So that could come as early as next week as well. So be on the lookout for that. If we get continued selling into next week, we have a very strong chance that the moving average on the S&P 500 will change to red, and that our posture will change to strongly bearish with that darker shade of pink showing up on the chart. So not a great look as we head into this holiday weekend. You can see here on the Dow Jones Industrial Average, it held up quite a bit better. It was today's relative winner. It was only down 0.33%. And remember, that's often the case. Whenever we have aggressive selling days, typically the Dow holds up a little bit better, all else being equal. Of course, there's always exceptions to the rule, but the general concept there is there's only 30 stocks in the Dow, and they tend to be your big blue chip companies. We talked about a couple of them in my question and answer session, as a matter of fact, today, Coca-Cola and Procter & Gamble. And Coca-Cola is just one example, is hitting all-time highs right now as the market is struggling. So you do kind of have that bulky feel of the generals of industry that are part of the Dow Jones Industrial Average that allow it to retain its value a little bit better when some of the more speculative areas of the market are really selling off. So that kind of bailed them out to a degree here today. And one thing I would also add is, remember, one peculiar aspect of the Dow Jones Industrial Average is that it has 0 utility companies. Remember what I mentioned before, that only energy and utilities were the only two that were rising sectors here today. So the Dow did not benefit from the strength in utilities because there are none. Remember, there's a separate index called the Dow Jones Utility Index that is specifically for utilities. So the Dow Jones Industrial Average owns 0 utilities. So they didn't get the benefit out of the utility strength today. They got a little bit of benefit out of their energy strength because, of course, Chevron's in there. But for the most part, the reason the Dow held up better today is because of the big, bulky, blue chip types of companies that are out there. Even still, it's not a great look for it because it does have this long upper shadow on its candle here, and you will see that it has its green line trending lower as well, so the intermediate posture is also considered weakly bearish at this moment in time. However, unlike the S&P 500, it'll probably be a little bit of time before it changes to strongly bearish. You can see here as you read the green labels in all 4 of the charts that you could get away with saying that the Dow Jones Industrial Average is this market's current leader, right? Because its intermediate line is the highest at 67. So it's got a ways to go before it falls below the 50th percentile there, and therefore it stands out. The other reason it stands out is you'll notice it's the only one of these 4 that is currently above a rising 30-day moving average. Notice the 30-day moving average is green on the Dow Jones Industrial Average chart, whereas it's yellow on the S&P 500 and red on the 2 charts down below. So yet another way to kind of distinguish between these charts and get away with saying the Dow is our current leader. It is retaining some semblance of strength compared or relative to the other charts that are out there right now. Down below here, you can see that the NASDAQ and the Russell 2000 really struggled today. In fact, the NASDAQ is somewhat unique today with this orange label in the daily range. Notice that today's range for the NASDAQ was more aggressive than its average true range, whereas we have blue labels on the other 3 charts, meaning they were slightly quieter days in terms of high to low range. But the NASDAQ had some pretty intense selling today. Not only was the range large, but the percentage sell-off from yesterday's close was also the largest. Notice the NASDAQ was by far and away the worst performer today, down 2.14%. Remember, the NASDAQ has really struggled in this environment because that's where you contain most of your higher growth stocks. They don't have the Coca-Colas of the world in the NASDAQ composite to help them kind of retain value the way that the Dow Jones Industrial Average can. And so the NASDAQ is going to struggle on days when, you know, Apple and Microsoft and Tesla and Amazon and, you know, Google and Facebook and all those that I rattled off before are down, which all of them were, and they all struggled today, and that all led to additional selling there in the NASDAQ composite on a comparative basis to the other indices that are maybe a little bit more broad-based. So not a good look there at all for the NASDAQ. An above average range day basically closed at the lows of the session today, engulfed the prior positive day's candle, and we are bouncing down and away from this falling 30-day moving average. Notice it is red. Not only that, but today's posture on the NASDAQ composite formally went to strongly bearish, not just weakly bearish like had been the case for the previous week. That's why that background color is changing to dark pink as opposed to light pink, and the reason for that is that green intermediate line has now crossed below the 50th percentile. It stands at 45 here currently. And then last but not least, let's take a look here at the Russell 2000. It was down basically 1% here today. You can see it also closed at the lows of the session, similar to the other indices. So again, it was a tough close. We were kind of nosediving there for the last hour or so into the close. And similar to the NASDAQ, it's bouncing down and away from this falling 30-day moving average. Now with the Russell 2000, it had already been weak, right? We have been talking about this for the last 4 days, that it's already in the strongly bearish category. So notice that it had a relatively short period with the light pink, and it's been in the dark pink for much longer than just the NASDAQ that went there today. So no surprise when we look at the intermediate reading, it's at 31, which is lower than the NASDAQ's there, and thus you could get away with saying that the Russell 2000 is kind of the laggard at this moment in time, where the Dow Jones is the leader. So not a great look there for the Russell 2000 either. Let's take a look here quickly at our 3 green arrows chart setup. And let me grab that here. It's chart 4D. And as we're looking at that, you can see that only one of these major U.S. equity indices has managed to avoid the fate of 3 red arrows. And that one is the leader that I mentioned before, Dow Jones Industrial Average. So if you were jotting down the resumes of these 4 different indices, this is yet another thing you could put down on the resume for the Dow Jones Industrial Average being the leader of this market. It's the only one that does not have 3 red arrows right now. Notice the background colors of all of the other 3 charts do have that pink background, telling us that we have 3 red arrows, and that's just colorful language to look at whether 3 different technical indicators are considered to be bullish or bearish at any moment in time. So we have the 30-day moving average red arrow, we have the MACD histogram red arrow suggesting that a loss of momentum, and we have the stochastic red arrow suggesting that we're closing near the lower halves of our ranges in recent trading history. So not a good look, once again, for these other indices that are out there. The Dow Jones is the only one that's kind of just hanging in there, and I wouldn't even say it's good, it's just preserving itself just a little bit better. Since this is the last day of the week, let me also take a look here at our 1040 crossover method. A lot of times David does this because he usually does the video on Friday as the final day of the week, but this is that rare week where we don't trade tomorrow. So today is the final day of the week. So let's see how things shook out here on our weekly candle chart. Remember, these charts are different than the other ones I've looked at thus far. The other ones were daily candles. These ones are weekly candles. And since today was the end of the week, these are solidified. This is how things ended for us here today. So you can see that you kind of have the haves and the have-nots. And the halves are the 2 charts on the top. The have-nots are the 2 charts on the bottom. And what I'm referencing when I say that is look at the pink background colors on the 2 charts on the bottom. What that suggests is that we have death crosses on the 1040 weekly candle moving averages. And so we use the 10-week moving average as the orange line, and the 40-week moving average is the blue line. So when the more sensitive orange line crosses down and through the less sensitive blue line, that usually gives you the impression that trading is bearish in the short term. And that is kind of what you can get away with saying, right? 2022 has been a tough year, and it's been particularly tough for the NASDAQ composite and for the Russell 2000 in accordance to how we're looking at this 1040 crossover. Now, on the 2 charts up above, we do have at least the good news that we still have a golden cross, and what that means is the orange line is still barely above the blue line, and you can see really barely because you can barely even point it out or pick it out with your naked eye. In the case of the Dow Jones, down here you'll see this PPO rank and this number just to the left of my cursor that says 0.14. What that is referencing is how close it is to the 0 line. If it were to go down to 0.1 instead of the plus 0.1 that we have right now, this would then be a death cross on the Dow as well. So that's a possibility here within the coming weeks. That's how close we are. And the S&P 500 is really close as well, right? The higher this green line is down below here, the more separation there is between the orange and the blue lines up above on the chart. So when it's really close to that 0 dashed orange line right there, it basically means that the 2 moving averages, the 10 period and the 40 period, are basically touching each other. And that is the case right now. So although technically we're still in bullish cross or golden cross territory, I mean, it is right there. It's like a coin flip right now. And I would also point out that these little red arrows that emerged above the candles this week suggest that price has now closed below the 10-week moving average. So although the 10-week moving average has not yet crossed below the 40-week moving average, price is now below the 10-week moving average. And usually you get a few of those candles going, and that gets things a little bit more bearish there as well. So it doesn't have enough of an impact to change the background color of the chart, but it's kind of like an early warning signal, I guess you could say. So again, not a great look from the longer term charts here on a 1040 crossover method, but at least we can say that the Dow and the S&P 500 still have golden crosses. But don't hold your breath, because these markets have been volatile, and we could have things change on us in a hurry here depending upon circumstances. Let's go ahead and now pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support this free video that we do for you guys. Many of you are aware that it actually takes us over 3 hours to do this video every day. And it's just David and I that work here. So it's not like we've got some team of helpers that's doing all this for us. We're doing all of it. And so we always have to ask ourselves the very basic question of, can we justify the amount of time that we spend on free videos like this? And in order for you guys to have a vote or a say in that conversation, I simply ask one thing out of you. Click like on Twitter. If you click like on Twitter, you will send the message to us that you want us to continue to do these free videos on YouTube as often as possible. And as long as we're up and over 100 likes, I'm happy to do the video for you. If we're under 100 likes, then it starts to give me the impression that perhaps these videos are not quite as useful as we would like them to be, and therefore maybe we don't need to do them as often, or maybe we don't need to do as lengthy of videos, or what have you. So if we get under 100 likes, then the next time around I would do a shortened 15-minute version of the video where there would be no trade application example. So that's why obviously we're well past 15 minutes already into this video. I'm doing the full video for you because 101 of you clicked like there. So we just barely got up and over it, but we did. And so true to my word, we're sticking with that. And so if you get value out of learning from us, in particular learning from the trade application examples that we give you, then naturally you'll be a little bit more motivated to click like for us there on Twitter, which doesn't cost you a single penny. It just takes 5 seconds out of your time. And so if you want to trade your 5 seconds for our 3 hours, that's your best way to get that accomplished. And thank you to all of you who do that. We have many of you that do that each and every time. And we certainly appreciate those of you that are highly loyal to us. So thank you to Kenneth and Margie and Keith and Tom and Jerry. And how about that? Tom and Jerry. And SW and Roger and Jim and Ron, H. Raffin, Tom and Dale and Fun Jonesy and Surendhar and Ron and Violina and John and Claire, Paul, Irene, Ed, Lucius, Kirk, Carl, Ken, Ting Ting, Dr. Bob, Richie Rich, Gerald, Ray, Irene, Fred. Too many to go through all together, but I always like to at least acknowledge you guys, and I do recognize when you are clicking like for us. So thank you to everybody out there that helps us along with that. You guys are amazing folks. Thank you so much. Please keep that up. In addition to that, we did teach our normal classes today. Again, tomorrow being a holiday, David will not be teaching his normal technical analysis class tomorrow, but today we did have our normal slate. So David taught his portfolio management with ETFs class, and I taught my question and answer session. And boy, oh boy, was it a doozy. We were actually in class for about 3 hours and 45 minutes here today. So, sometimes people say, well, Brandon, don't you like doing those free YouTube videos? Doesn't it give you a voice and a platform and a chance to teach? And don't you just love that? And I say, yeah, I do like all of that. But the truth of the matter is I'm already doing that for the actual job that I have for our premium members, right? So I don't need to do it twice in a day. But if you guys get value out of it, I'm happy to do it. Let's put it that way. So earlier today we had quite the marathon session. Here are some of the questions that we addressed in case you are a premium member and you want to go check out the recording later on this weekend if you're looking for things to keep you busy while the stock market is closed there tomorrow. So I got a question about how do I look for a long list of attractively valued dividend growth investing candidates, discussing possible scans and other approaches to look for dividend stocks. I also got asked a question on looking at RGA's business model as a reinsurance company. I also got a question about 3M as one of those kind of traditional blue chip dividend aristocrat / king types of companies, and discussing some of its difficulties it's had recently in the courtroom and how we should think about that as long-term investors. I also got a question about People's United and their acquisition by M&T Bank. Of course, some of our students owned People's Bank from some of my dividend classes, so we were thrilled to see some nice profits come in as a result of that merger that took place recently, and then how to kind of look at that on the Thinkorswim platform and what we need to do to correct cost basis and different things like that. Also got a question about thinking about how the markets in general are a bit overvalued. In fact, by some metrics, so overvalued that you can only compare it to the .com time period, and how that might affect our mindset, especially from a dividend growth investing kind of long-term perspective. I then got a question on how to use the 9 at 9 graphic that I post on Twitter and also post to our website each trading morning at 9 a.m. Eastern Time. And I used yesterday as an example of how to identify patterns within the 9 at 9 to then make money on other types of securities that might not be getting the credibility pre-market. And so we had a very interesting conversation about that. We also talked about Southwest Gas today. We've actually talked about that one a number of times since October, when Carl Icahn launched his campaign to try to buy out the company. Southwest happened to be a company that we had bought just in a couple of weeks prior to Carl Icahn making that announcement in my dividend growth investing class, so we were quite fortunate with our timing on that one. We also got a question on how to interpret when the Thinkorswim platform is giving you a wonky P&L number, and how when you have really wide bid-ask spreads on options trades, on particularly illiquid securities, how the Thinkorswim platform can sometimes give you misleading information if you don't know what to look for. I then got a question about borrow fees that may or may not be charged when you're short selling stocks on different brokerages that are out there. And I also got a question on Goldman Sachs as a possible dividend growth investing candidate. So today was quite a doozy. You can see lots and lots of stuff that we talked about in that 3 hours and 45 minutes there today. So feel free to check that out if any of that catches your interest and you are a premium member of Market Scholars. Also, while we're over here, wanted to take a look at the Factor Selector tool. The Factor Selector I usually post to our website on Wednesday morning just before I teach my factor-based swing trading class, and is based upon Tuesday night's closing information. I actually shared this with you on Tuesday during this video as well. Typically I don't. My normal routine is I usually go through the sector selector with you guys here on the YouTube video on Tuesday, since it's the freshest at that point, and then the factor selector here typically on Thursdays. But since last Thursday I was gallivanting around Vegas and the Grand Canyon, and I didn't get a chance to have this video a week ago today, we kind of did the factor selector twice this week. So just to kind of reiterate, we didn't really see much change on the factor selector week over week. You can see low volatility stayed number one, and you can thank your utility stocks for that stellar performance. And then you've got your dividend yielders sticking at number two there. And again, going back to Coca-Cola as just one example, hitting an all-time high here today. Some of those blue chip companies holding their value, retaining, preserving their value a lot better than the more speculative stuff out there these days. On the downside of the graphic for the second straight week, we did have the low size category or small cap universe really struggling. And going back to what I just mentioned to you a moment ago, when we were talking about leaders and laggards from the broad 4 equity indices in the United States, and I was saying how the Dow Jones was our leader. You can kind of think of dividend yield as Dow Jones, and then I said Russell 2000 was our laggard. You can think of the low size factor as being kind of representative of the Russell 2000 small cap index, and so it does kind of seem to make sense in terms of how the rankings shook out here this week. All right, let's get back on track with some more charting analysis now, and let's take a peek here at our 12 grid analysis, starting with chart 5A. And as we're looking at chart 5A, you'll notice here that our bottom rung stands out like a sore thumb because they are the only charts that have a green background color. All of the 8 other charts above it are all pink, and what that means is the bottom rung are considered to be bullish postures according to the market forecast, whereas all of the other charts above it in pink are bearish postures according to the market forecast technical indicator. And that has been kind of par for the course, right? If there's been a theme thus far in 2022, when I've talked to you about this 12 grid here, it has been the strength in the bottom rung. Over and over and over again, I've sounded like a broken record. And hopefully some of you have been listening because those have been very profitable areas to be involved in, whether getting yourself into gold or gold miners, into oil itself or oil stocks, getting into the treasury yield, which is a little bit harder to do. I guess you could go in short bonds, and there are some products out there like TBT, which is kind of a inverse bond product that benefits when interest rates go up. So there's a few ways to take advantage of that. But then also the US dollar being strong. These themes have been in place this entire year for the most part. There's been a few times that are touch and go here and there, but for the most part, it's been consistent. And so that's why they always say the trend is your friend until the end. And what they're referencing with that, that rhyming scheme there is that trust that the market knows what it's doing when it sends securities into trends, and try to take as much of that trend as you can as a trader. Now, as an investor, you might have a different mindset, but as a trader, it's important to pay attention to what the market is telling you, not what you think should be happening. And in order to do that, you need to be able to use your eyes. As long as you use your eyes and you don't let your brain confuse you too much, you can oftentimes make some decent money on the trends. Not always, right? Life is never as easy as it may seem, but clearly, had you had some exposure to oil stocks in 2022, as soon as you've seen the trends emerge, you probably are thankful for that exposure at this moment in time. So we had quite the day in the interest rate world. TNX went up to its highest level in well over a year. You can see that the TNX is now at 2.82%. And you can see what that candle looks like there. I was talking on Tuesday how, it had sold off for one day, and I said, don't get too aggressive with the thinking there with the sell-off because, one day does not make a trend. And here we are just a couple of days later, and not only did we reverse that day's bearishness, we reversed yesterday's bearishness all in one fell swoop, and we're back to all-time high, or not all-time highs, but yearly highs on the TNX. And so interest rates surging. In fact, it's not just interest rates on government bonds, but mortgage rates are going up dramatically as well, as we just hit 5% on average in mortgage rates. So that could start hitting the housing market, as we've been discussing here recently as well. So keep your eyes on that possibility later on in the year. Oil finished the day strong. It was up another 1.5%. And this is what I was hoping for. Remember what I mentioned to you guys on Tuesday. On that day, we were sitting right on the moving average. And I think the background color was light pink at that time. And I said, this is kind of the make or break moment. We need to see this get up. And I for one believe that it will. Now, I didn't have any sort of special insight or a crystal ball or anything like that. I just basically have a simple trend following mindset. What we have known in the past is that every time oil has pulled back in the year 2022, it has been bought. And like I said on Twitter there a couple of weeks ago, is that probably a month ago at this point, I said, I personally believe that oil and oil stocks are criminally under-owned. And what I mean by that is I really get the sense that the average trader out there refuses to buy oil. For at one point, many folks refused to buy it because they were in downtrends. And they said, well, oil companies are bad for the environment, and they're just a poor investment in general, right? There's plenty of excuses and reasons why you can choose not to invest in oil companies. Believe me, I've heard them all. So there's a lot of people that just have a closed mindset towards the idea of owning oil stocks right out of the chute. Now, of the folks that have an open mindset, what I think happened with a lot of oil stocks is they went up so rapidly that even those that are willing to own oil stocks still have an underexposure to them because they kind of felt like they went up so fast that they needed a pullback before they could feel comfortable buying them at a more appropriate valuation or something along those lines. So I think oil stocks are in a peculiar place where they are vastly underowned. And I think it's not just an issue with retail investors. I think this is an issue that stretches to institutional investors as well. Even looking at Warren Buffett's approach, where he has been buying aggressively Occidental Petroleum, he is usually not the person that chases price up. But you can almost read between the lines in this case that he kind of feels like even he's underexposed to oil at this point, because normally he's going to wait for stock prices to come down to him. But in this most recent round of purchasing of Occidental, he kept on buying it as the prices kept on going up. So it just feels to me like oil and oil stocks are chronically underowned. And there could very well be a lot more to this trend as we see it develop in 2022, especially in a highly inflationary environment like we find ourselves in. Gold was down just a touch today, only 0.33%, but you can see it retains its weekly bullish posture and it's still above a rising moving average, so it's still in reasonably good shape. And then the US dollar strong once again. It was up 0.45% today, strongly bullish posture combined with above that rising 30-day moving average there. So our bottom rung still looks like our superstars. Everything else looks pretty darn lousy, if you ask me. Bitcoin was down again today. You can see it's really been kind of struggling back and forth with that 40,000 kind of big round number here this week, and it closed just a hair below 40,000 here today. We can see that high yield bonds, foreign bonds, and long-term U.S. Treasuries all fell today. In fact, you could almost get away with saying the long-term U.S. Treasuries collapsed. Look at how bad that candle looks there. It's one of the worst on the board. That one might have been a little bit worse there back on March 2nd, but there's not a whole lot of candles out there that are as ugly as it was today. And this is a fresh low, right? This is a multi-year low on TLT. This is not a good look, but it is what you would expect when you see interest rates surging, like I had mentioned here earlier. As far as the top rung goes, still a struggle out there, regardless of whether you're in the United States or across the globe. EFA, that tracks our developed foreign stocks, was down about 0.5% today, and then EEM, which tracks the emerging foreign stocks, was down well over 1%. In fact, it underperformed the S&P 500 today. And so not a great look there for EEM, as not only do you have a weekly bearish posture, but you also are back trading below that falling 30-day moving average again. So path of least resistance continues to be to the downside for a lot of those foreign securities out there. Let's take a look at the sectors now. And so this is chart 5C. And as we're looking at the sectors, kind of an interesting mix here. You almost have the lower right corner housing our green charts, and then the upper left corner housing our pink charts. So let's go through them. On the bottom rung, remember, I intentionally put the defensive areas on the bottom. So we did lose the bullish posture out of healthcare. So that's a little bit of a disappointment there. They looked awfully strong late last week, but they kind of had an underwhelming week, to put it lightly. So that had enough of an impact, the selling that we did see in 3 out of the last 4 days, where the background color did switch back to that light pink, telling us that we have a weekly bearish posture. Remember, for those of you that are premium members and have access to these charts, you just right click and go to maximize sell, and then you can see the actual indicator down below, and you can see that on healthcare, that green line did fall out of the upper reversal zone, just barely. It's at 77, so not that far away from 80, but that's why the background color did change to pink here in the last 48 hours. Whereas the other 3 defensive areas remain strongly bullish, not even weekly bullish, and that's the staples, that's the utilities, and that's real estate. And as I mentioned before, utilities managed to close higher today, not by much, but they were up by 0.05%, and the staples just barely missed closing in the green today. They were in the green earlier in the session, but by the end of the day, they did close lower by 2 pennies, just barely crossing below that break even there. Whereas real estate was a little bit harder of a sell-off. They were actually down 0.5% here today. In terms of these other two green charts just above it, materials were down 0.34% today. So they actually did a little bit better with materials than they did with real estate today. But energy, once again, the king. Right? Energy has been the king, continues to be the king. It was up another 0.33% today, and we basically have a fresh multi-year closing high on XLE. You might have had a slightly higher intraday high back here, but from a closing high basis, you're looking at it. It's right now. And so, again, be thankful if you have any oil stocks in your portfolio right now. They are helping you kind of get by. They might not be fully offsetting the disaster that is much of the other sectors, but at least you're doing better than if you didn't have any oil stocks at all. And believe you me, there are a lot of people that own exactly zero oil companies out there because they've refused to own them. And so they have to kind of pay the price this year for that decision. Now, in previous years, they've made the wise decision, right? So it works in cycles there. But right now, if you have any oil stocks in your account, you should be thankful for that. In terms of some of the worst performers today, it got pretty ugly in technology. Look at technology down 2.43%. Ugly day. Completely engulfing yesterday's bullishness. Not only that, but taking it an even further step lower. Remember when we were looking at the NASDAQ composite? It basically just closed at yesterday's low. Well, the tech portion of the NASDAQ composite did even worse. You can see the tech sector fell dramatically lower than where the lows were on the candles earlier this week. So not a good look there. The good news is they're still above the lows that they had in the middle of March. But in this most recent round of trading, tech stocks have really been sliding right there. Again, some of those bigger players like Microsoft and NVIDIA and Apple and those companies not really helping us along. Another area that really struggled here today was communications. Remember, communications is kind of like tech's stepbrother. You could kind of think of it. While there are some telecom companies in communications, what drives communications from a market cap perspective is Alphabet and Meta, right? Or the old Google and Facebook. And so you kind of tend to think of those as tech companies as well. And they struggled today. They were down 1.7 as a group there. And then consumer discretionary also had a tough day, down 1.4%, as Tesla was down quite a bit, as some people maybe interpreted Elon Musk's actions earlier today as a place where if he was serious about buying Twitter, he might need to come up with tens of billions of dollars worth of cash somehow, and perhaps one of the ways he would do that is sell some of his Tesla shares. So Tesla took it on the chin as a result of that today, and Tesla is one of the three most influential members of XLY, the consumer discretionary ETF. So those areas all struggled, and remember what I'd mentioned to you guys on Tuesday when we looked at the sector selector. Those are the three that were dead last on the sector selector: technology, communications, and discretionary. So not a huge surprise to me, at least, that they were the worst performers on this ugly day today as well. All right, so let's now get into our trade application example for the day. And as I'm sure none of you are surprised by if you've been listening to my videos this year, I went with a sold put trade. I'm joking with you, of course, but it is true. I've been doing tons of sold puts. And the reason for that is I think these are awesome times for selling puts. It's not just that I'm lazy and I'm doing the same type of trade over and over again. I actually like doing sold puts when the market is in an ornery mood like we've had here recently. And the reason for that is we get a little extra juice when we're selling puts when the market is in a bad mood, right? When the market's in the bad mood, the VIX goes higher, volatility goes up. When you're selling premium, you want to sell something that is expensive. And one of the three things that makes a contract expensive is volatility. So when volatility is up, all else being equal, that contract is a bit more expensive. So I actually like operating in these kind of chop and slop, more difficult markets when it comes to selling puts. And we went through all of those sold put trades on Tuesday's video that we were basically making money on all of them with the exception of Best Buy. We were down like $3 or something like that. So the point is we've been doing really well with the sold put. So if it ain't broke, let's not fix it. How about that? So we're going to do another one here today. In fact, I'll take that kind of analogy a step further. We're actually going to do the same one over again. And that is the beauty of the options market, is that options expire, unlike stocks. And when options expire, you have the ability to do similar trades on them. And so let me show you which one we're going to be doing. Remember, I've already done the trade, and I already sent out the Telegram message for all of you who are premium members. And this is on Jpmorgan. This was done about 15 minutes before the closing bell to give all of our premium members some insight into what we'll be talking about in the free video later on, and give them an opportunity to trade it if they so desire. Obviously not a recommendation there or anything. But the reason I said it was kind of a repeat is because we just had one expire today. So let me come on over here to the trade tab, and you can see down below, if I were to click out of there, our April Jpmorgan sold put, which was the 100 sold put that we originally sold for $1.04, basically expired at max gains for us here today. You can see 99% of our gains there, just in a reflection that there was 1 penny on the ask. But effectively, that's a 100% max gain that we just had when we let a sold put trade expire worthless. So in other words, we took in $104 by saying we would be willing to buy 100 shares of Jpmorgan at exactly $100 per share if it were trading there on April expiration, which was today. And of course, Jpmorgan has struggled lately, but it didn't go all the way down to 100. It just went to 126. So when that happens, then we keep our parting gift. So that was a free $104 that was just injected into our portfolio. Now with that one expiring today, I thought, let's try to do another one. And so I did. I did the June 105s this time. So notice the difference there. It's not the 100 like with the April contract. So it's a 105 this time around. And I was able to get exactly $1.05 for trading that. And I usually do like to target that 1% return on risk area. Now what makes this one a little bit different is I went out a little bit further in time than I normally would with 64 days. Typically I teach my students to go between 20 and 60 days. So this one's just a little bit beyond that. You know, once we get to Monday, that'll be back down to the 60. So really I only skirted that, you know, guideline by 1 trading day there. So on Monday when we get together, it'll say that there's 60 days left of that contract, and then it would kind of fit my traditional way of teaching there. But I would have gone with it with the maize if I could have gotten the 1% return close to that strike price. But as you can see up here, if I were to go with the maize and kind of do the 1% return on risk area, that would be right here, and that would be the 115 strike. And I thought to myself, you know what? We're in pretty difficult market right now. It's probably better to be, you know, safe than sorry. Give yourself a little bit of extra room to be wrong. And so by avoiding the May setup, I'm going out to June, and I'm giving myself $10 more worth of flexibility from 115 down to 105. For those of you that are somewhat new, you know, basically when I'm selling puts and how I'm teaching it to you guys here is it's basically a way for you to try to buy a company at a lower price. In return for your willingness to do that, you get paid a credit up front. So I did the June 105s here, got paid 105 as opposed to the 104 I got when I did the Aprils. Now, as part of the teaching that I was kind of referencing earlier when I asked you to remember that on March 1st, the VIX was at 33, what I was getting at, what I was driving to was this. Notice that on the April contracts, if I were to click on the quantity there to show us when did I get this trade done, it was on March 1st. It was about midday there. Some of you may recall that I called this my 15-second decision. That's how confident I was in this trade. I didn't even have to think twice about it. I just took the trade. And that is very rare for me. I'm, as many of you know, too thorough for my own good sometimes. And so sometimes I really hem and haw and go back and forth on what I should do. That was the rare time I was very, very assertive, and I said, let's do it. Don't even think about anything else. We're doing that trade. Because I knew at the time that, you know, given where Jpmorgan's dividend policy was, that if it did get to $100 per share, it would be a 4% yield. And I knew that it is fairly rare for Jpmorgan to have a 4% yield. So I wanted to take the market up on its offer as soon as I saw it. Well, the reason I wanted to kind of highlight this is notice that with today's trade, it is what I would perceive to be worse than what we did in April. Why I say that is When we did the April trade, remember it was on March 1st. So on March 1st to here we are in the middle of April, that's approximately 45 days. Remember what I just got done talking about here a moment ago. By doing the June contract today, we have to be in this for 64 days, nearly 20 days more than this original trade that I did for the April contracts. Not only that, so in other words, the way you can think about that is you're going to have risk for 20 extra days with the way that I just did the June contracts today compared to when I had that layup of what I thought was a layup back on March 1st for the April contracts. So that's one way where this trade that I did today is slightly worse than what we looked at there on March 1st. Another way that it's worse is that we are now obligated to buy it at 105 as opposed to 100, right? You'd rather have a cost basis of $100 per share than 105. So that's another way where it's slightly worse. And we basically got the exact same amount in the trade itself, 104 versus 105. So a difference of $1 there, but that's it. So what I wanted to highlight for you here is if we were to come over here to the chart and see where things stand for Jpmorgan. So first of all, a lot of the same things I'm interested in still exist. Jpmorgan has been downtrending. It's a stock that I admire a lot and one that I think is a great fit for a dividend growth investor's long-term portfolio. Notice what we have here today that has showed up. It's a little green dot, and that little green dot means that we have an oversold cluster signal on the weekly candle chart. We would have to go all the way back to right here, back during the Christmas time period of 2018, since the last time we had an oversold weekly cluster on Jpmorgan. And you can imagine that if you bought Jpmorgan during Christmas of 2018 when it was a $93 stock, you're still feeling reasonably good with that decision because not only have you had some capital gains along the way, but of course you've received all of these dividends in this yellow bubble down below here along the way as well. So it's been reasonable. It hasn't been a home run, but I think you'd been happy about that, right? So the point that I'm trying to make is these oversold cluster signals on Jpmorgan are very rare. They hardly ever show up, and when they do, it's worth paying attention to, or at least that's the way that I'd like to think about it. And in this case, not only do you have an oversold cluster signal, but you're approaching the blue line on the dividend stair-step chart. Remember that blue line on the dividend stair-step chart is a way to gauge the current dividend yield versus where some of the extreme high yields have been over the last 10 years by averaging them all together and then plotting it on that blue line on this 10-year weekly candle chart that we're looking at here. So in other words, the way that I would be teaching my dividend growth investing class on Tuesday mornings is we would become interested in Jpmorgan once it came down to that blue line right there, which means that it would be trading at 121.95 or less. So we're about $5 away from that right now. In other words, we could not buy it right now according to our rules, but if it were to continue to slip, we might very well consider that possibility for our DGI portfolio on Tuesday morning. Until then, we think about it in a different realm, and that's where the selling of puts comes in. And if we were to sell a put with a strike price in that blue zone, then we can feel a little bit more comfortable. We can justify it in our heads that, hey, we've got ourselves a situation where if the stock continues to fall, we know that it'll have a yield of over 3.28% if our strike price is in that blue zone and the stock closes below there. Now, going back to that kind of teaching element that I had mentioned before, one thing that I find to be fascinating about this is if you were to look at where this stock was trading on March 1st, it would have been somewhere around right here. I can't get perfectly on it because it's not a daily candle, it's a weekly candle chart, but it's about right here that I'm circling with my mouse. Notice that the stock was trading about $10 higher at that time than where we are trading right now. And that's important because going back to how I was mentioning before, that today's trade was worse than what I showed you guys originally back on March 1st, that should ring a bell, right? In other words, most of you know that the lower a stock price goes, all else being equal, the put prices should become more expensive, not less. But I just got done telling you we did worse today than we did back then. And the reason behind that is volatility. Going back to what I'd mentioned before, pay attention to the VIX at 33 on March 1st versus 22 today in real time on April 14th, and that explains the difference. If you're only looking at price, then we should have had a better deal today than we got on March 1st, and that was not the case. So, it's important to remember that there are three components to the options pricing model. There's price, there's time, and there's volatility. When it comes to price, we should have gotten a better deal today because the current price is lower, yet we had to sell the 105 put today, not the 100. When it comes to time, we should have gotten the better deal today because we have to be in this trade for 20 extra days than we were in that first one. So 2 out of the 3 pricing components of the options contracts should have actually been in our favor by placing the trade today, yet we had a worse setup today than we did on March 1st, and the reason for that is the third element of that pricing contract, which is volatility. And because volatility was way higher on March 1st than where it is today, it had an overwhelming impact on the pricing of the put contracts as well. So I still like the setup today, but I wouldn't necessarily go as far as how I described it back on March 1st as a 15-second decision. Today, it took me a little bit longer to get comfortable with it, but I still think down here at $105, if push came to shove and we were forced to buy Jpmorgan at that level where its dividend yield would be fairly close to a 4% yield, that would be an attractive situation for long-term investors. Okay, so that's what I had for you. I hope you enjoyed that. I hope you understood that educational element there, or at least follow along with part of it. And if you did, I ask one simple thing out of you. Click like for me on Twitter. It takes 5 seconds out of your day. It doesn't cost you a penny. And it encourages us to do these videos as often as possible in the future. Now, beyond that, I have one other request for you, and that's to have an excellent Easter. I hope all of you enjoy your holiday, and we look forward to serving you bright and early on Monday morning for top-down trend trading in our premium classes. So with that, I want to wish you all the best of success with your trades and your investments. Goodbye for now.